Welcome to Taking Stock for Friday, May the 9th. I'm Jason Yin, and joining me today is my colleague Charlie Song. Welcome to this episode, Charlie. Haven't had you on for a while.
Yeah, that's right, Jace. Glad to be here.
Fantastic. Welcome, welcome. We have a lot to unpack today, from politics over to portfolio moves. But before we dive in, just a quick reminder for everyone that the information we share today is of a general nature only and should not be considered personal advice. Remember that the share market can be volatile and past performance is obviously no guarantee of future results. Well, Charlie, let's start off with the big domestic story of the week, which is Labour's election victory.
That's right, Jason. With Labour securing a majority, markets have quickly shifted to pricing in the party's fiscal priorities. Infrastructure, healthcare, and social services are set to benefit most, with announcements around increased public spending on aged care, renewable energy, and social housing. On the flip side, sectors like private health insurance, coal, and traditional energy producers may see less favorable conditions due to regulatory overhang or redirected subsidies.
Yeah, it's interesting with what's happening. It's also clear that the government is also leaning into more activist industrial policies as well. And there's a bit of a renewed focus on domestic manufacturing. And like you said before, Charlie, a bit of a clean energy transition as well. That could support construction, technology sector, and potentially even the lithium names as well. Although the latter may face some global pricing headwinds with all these tariff talks.
Yeah, that's right, Jace. And speaking of global headwinds, we also saw some interesting moves on the macro front. In the US, non-farm payrolls data showed some softening in the labor market, while the ISM Services Index surprised to the downside. That's reignited hopes of rate cuts from the Fed as early as September.
Yeah, rate hopes are definitely one of those things that the market is sort of clutching on. Over to home, the Australian retail sales data has been relatively weak, and the RBA has sort of kept a cautious tone. Economists are now forecasting rate cuts to begin in late 2025, and the cash rate potentially drifting towards the 2.6% by early 2026. And this could provide some relief to mortgage holders and also support domestic consumption as well.
Yeah, another big story is the easing in the US-China rhetoric. Overnight, both sides confirmed they've resumed tariff negotiations, with the US Trade Representative and China's Commerce Ministry agreeing to restart working group meetings. This follows a stretch of heightened tension, so any thawing in relations should help sentiment, especially in export-sensitive sectors.
Yeah, I remember there was a bit for tit for tat this week, Charlie. I think the US was saying that China would call them first, and then China said the US would call them first. So it's definitely interesting with what's happening in terms of trade talks. But over to some of the news this week, we've had the Macquarie conference over in Sydney, and there seems to be a strong focus on in terms of capital discipline and also earnings resilience as well. And this is especially in more uncertain global backdrop as well. Which brings us to some of the company updates that we've seen this week. And starting off, we've had the National Australia Bank, which is one of our star income stocks. Now, the bank reported a steady 1H 25 result. Its cash earnings rose 1% to $3.6 billion, which was slightly ahead of consensus. But importantly, the dividend was maintained at 85 cents per share, which is fully franked and implies a gross dividend yield of around 7%.
Yeah, margins have held up pretty well in that business, with net interest margins, or NIMs, of 1.7%. Though excluding treasury and markets, that did dip slightly. Cost disciplines were on show, with $131 million in productivity gains, partially offsetting a 3% rise in expenses. The CET1 capital ratio remains pretty healthy at around 12%.
That's pretty good, and that should obviously support its financial health rating. Bad debt charges, on the other hand, declined modestly, and NAB even released $194 million from forward provisions, and this signals a more balanced outlook in terms of credit risk. However, we are seeing some pressure in terms of asset quality, and this is particularly in the business lending sector as well, and to a lesser extent in the mortgage book. So that's something to definitely keep an eye on.
Switching to gold, Gold Road Resources, GORE, has accepted a revised cash bid from Gold Fields, their joint venture partner. That values the company at around $3.40 per share, including a special dividend of 35 cents. This appears to be the final offer, with Gore's board recommending shareholders vote in favor. A few large shareholders have already signaled their support for this scheme.
Hmm.
Catalyst Metals also has made headlines with its $32.5 million acquisition of the Old Highway Gold Project, which they've acquired from Sandfire Resources. The project is near Catalyst's existing plutonic mill. It's only 40 kilometers away and is expected to produce 35,000 ounces annually once ramped up. While it will take a few years to reach that steady state production, the acquisition does look sensibly priced and incrementally positive for group production.
Yeah, there's definitely a lot of positive sentiment in the gold sector, Charlie. A bit of M&A as well, and a lot of companies obviously buying or acquiring other companies for growth. Moving on to some of the consumer names, Charlie, and this is one that you like and is under your coverage, which is Endeavour Group. Now, the company reported a relatively mixed third quarter 25 result. Retail sales were a little light, and it was down 1.3%, and this was partially due to the timing of the Easter holidays as well, but also hotel sales outperformed with nearly 5% growth, which has been exciting. Management remains relatively upbeat and they're forecasting flat to modest growth in retail and also mid-single digit growth in hotels for the remainder of this quarter.
I really do think Endeavour's valuation remains very undemanding,
Mm.
and any sort of growth from the business long term should present itself as upside. Coles also reported their third quarter update, which was broadly in line. Supermarket sales did rise 3.7%, and that was supported by balanced volume and inflation contributions. Liquor was a little softer due to the absence of Easter trading, but trends are improving in the fourth quarter. The overall narrative is one of stability, which markets will take any day in this environment.
And in under the microscope this week, we take a closer look at Westpac Banking Corporation. Charlie, can you kick us off with a few quick rundowns of the bank's first 25 result, please?
Yeah, absolutely, Jace. So Westpac posted a first half 25 statutory net profit of $3.46 billion. That's down 4% half on half and roughly 2% below what was market expectations.
Mm.
The miss was driven by a higher effective tax rate, softer markets income, and continued net interest margin or NIM compression, which was down 4 basis points to 1.92%. Business and institutional lending were, however, bright spots, up 14% and 15% respectively. But home loan growth tracked just under system growth.
Well, margin compression, or what you mentioned earlier, NIMS, Charlie, remains a bit of a hot topic. I'm just curious how management is cushioning the impact of that margin squeeze.
While Westpac's replicating portfolio, which is a hedging mechanism that stabilizes deposit income when rates move,
Mm.
added about 3 basis points of protection to NIM this half. Even so, management acknowledged ongoing pressure and trimmed the interim dividend to 76 cents a share. 80 cents per share was what consensus was forecasting.
Right.
That equates to an annualized payout ratio of roughly 76% and reflects a disciplined stance on capital while still rewarding income-focused investors.
The dividends remain relatively robust, but what about from a balance sheet perspective, Charlie? How robust is the bank's capital position?
Yeah, and that's really key here. We think that capital does remain a key strength. The Common Equity Tier 1, or CET1 for short, ratio sits at 12.2%, which is comfortably above APRA's unquestionably strong benchmark.
Mm.
Asset quality is solid, with bad debts just 6 basis points of gross loans. Management has also completed about 69% of a $3.5 billion on-market buyback, preserving flexibility to lift shareholder returns if conditions allow.
Right. So balance sheet, from what you've said, remains relatively robust as well. I've also noticed that management's commentary that they did mention that costs are edging a little bit higher. What's behind some of the factors on that?
Yeah, so management is currently pursuing a multi-year technology and process simplification program, which they've called Project Unite.
Right.
That project is worth or expected to cost $3.3 billion dollars. Only 12% of the budget has thus far been spent, but those upfront costs pushed operating expenses up 6% year on year and lifted the cost to income ratio to 51.8%.
Hmm.
Management argues that there are strategic investments aimed at unlocking meaningful productivity and digital capability gains longer term.
Right. So the acceleration in costs is effectively to drive future efficiency, which makes sense, short-term pain for effectively longer-term gain. But from the outlook of the medium-term duration, I mean, we're seeing slowing credit growth and also fierce mortgage competition. How does the bank stack up in terms of the competition?
Yeah, so consensus now expects modest EPS, earnings per share, and dividends per share, DPS, growth over the next 12 months.
Hmm.
That reflects lower net interest margin assumptions and higher operating cost forecasts. We think there are some active risks around that mortgage margin compression as major banks do jostle for share, and
Hmm.
geopolitical macro uncertainty could temper credit demand. That said, Westpac's capital buffer and relatively low credit losses do provide resilience, and management have flagged a willingness to exceed its payout ratio ceiling to keep dividends consistent.
Right. Okay. Um, from a management perspective, Charlie, the new CEO, Anthony Miller, is taking over the reins, with bigger growth ambitions. Can you shed any light on his game plan?
Well, Anthony Miller wants to re-energize business banking, cross-sell core financial services, and simplify the business's legacy systems. He's adding 450 bankers and rolling out AI-driven efficiency tools. His 2029 vision is to lead peers on customer satisfaction, cost efficiency, and returns. But delivering on this will require very tight capital discipline and clear execution milestones, which is no small task in an increasingly commoditized, margin sensitive sector.
Yeah, so it seems like the new CEO is pretty keen to drive a lot of that future growth, Charlie. But one thing that the bank needs to balance is obviously short-term trans or longer-term transformation with some of that dependable income in terms of that sustainable dividend distribution. But from a valuation perspective, Charlie, they're trading on roughly just below 16 times, which is also below the sector average as well. So for any income investors as well, it seems like the current valuation is pretty balanced for what remains a relatively dependable dividend policy. Now, Charlie, with Warren Buffett preparing to step down from Berkshire Hathaway after more than 6 decades of extraordinary leadership, are there any enduring lessons that investors can draw from the world's most successful capital allocator?
Well, the 2025 Berkshire Hathaway AGM was certainly a celebration. I know we had it on in the office, Jason, but
Hmm.
also a reflective moment as Buffett announced his intention to step down by year end, which caught some of the investors by surprise. For perspective, Berkshire has compounded its per share value at 19.9% annually since 1965. That's almost 60 years, which is nearly double the S&P 500's per share value gain of 10.4% over that same time period.
Yeah, those are definitely some pretty impressive performance figures, Charlie, and a lot of people, that's why I look up to Buffett. And in terms of honoring Buffett's legacy, let's revisit some of the four timeless principles that his close partner Charlie Munger has sort of lived by, and these principles helped them achieve not just success in the market cycle, but also sustain a lot of that outperformance over their lifetime. What are they, Charlie?
Yeah, so these principles aren't ones that we've come up with. They're ones that we've taken from Charlie Munger's Poor Charlie's Almanac. So
Hmm.
the four principles we will talk about are preparation, patience, discipline, and objectivity. Preparation is essential. We think understanding a company's fundamentals and the industry dynamics reduces the risk of permanent capital loss. Without knowledge of the underlying activities of a company that one is invested in, an investor is no better than a blind man at a racetrack.
That makes a lot of sense. The second principle he does mention is patience. And this allows for time to let good ideas flourish. And as Benjamin Graham put it, in the short run, the market is a voting machine, but in the long run, it's a weighing machine. And this is something investors often forget because falling prices can be a bit of a gift if you're a long-term buyer.
Of course. And the third principle was discipline. And discipline really means knowing your limits as a human being, but also specifically as an investor. We
Hmm.
often overrate our ability to assess complex businesses in, even more complex environments.
Hmm.
Staying within your circle of competence, which is staying within things that you really do have an idea about, is really important as an investor. If you don't understand it, don't invest in it.
Makes sense. And the final one is objectivity. And Munger's always warned about psychological biases. If we fail to recognize how emotion and ego distort judgment, then we really risk sabotaging our own processes. The best investors are humble within their limitations.
That's a fitting tribute to the two of the greatest minds in investing ever, and a good reminder that temperament, not IQ, is really what sets great investors apart.
And this is one of the great things, Charlie. A lot of successful investors have often operated within frameworks. And this is what we at Stock Doctor try to impart to some of our members. The Nine Golden Rules framework is effectively a good resource for most investors to follow and also to help them achieve longer term success. Well, it's been a great session this week, Charlie, and that's a big wrap in terms of all the political and macro and market commentary that we've seen over the week. We will continue to monitor the implications of the new um, federal election agenda and also any global tariff talks as the landscape of definitely continues to evolve. Thanks for tuning in. I'm wishing everybody a very happy Mother's Day weekend. My name is Jason Yin.
My name is Charlie Song, and we'll see you next week on Taking Stock.